And, are we in an AI bubble? Of course, right? We were
Of course.
in that bubble. Of course.
It's time to call the third bubble of our century the AI bubble.
AI bubble, of course, continues to be a key focus.
So we are absolutely in an AI bubble now. It is going to burst.
So clearly that's the big question at the moment. Is AI a bubble? AI stocks ripping, valuations exploding, and a growing debate whether this is sustainable or just another tech mania. And there's a fair reason this conversation is happening. By late 2025, Nvidia became the first company in history to surpass a $5 trillion market capitalization. At the same time, Canada's nominal GDP for 2025 was around $2.28 trillion, ranking it 10th globally. She had a single company, not an entire sector, not an index, worth more than twice the annual economic output of Canada. So on the surface, this does kind of sound ridiculous, and it's exactly that kind of comparison that makes people instinctively say bubble. But comparisons like that can be misleading unless you understand what's actually driven the valuation. First things first, some people may even be wondering, what does Nvidia actually do? At its core, Nvidia designs advanced semiconductor chips, primarily GPUs, that are optimized for processing massive volumes of data simultaneously. This matters because modern AI systems don't scale linearly. Training and running large models requires parallel computation at a level traditional CPUs simply can't handle efficiently. And if none of that made sense to you, you probably wouldn't be alone. What it really means is Nvidia builds the chips that let AI process huge amounts of information at the same time instead of one task after the other, so it can run millions of calculations at once. And this is why they're essential for training and running modern models. Also, while companies like Amazon, Microsoft, Alphabet, and OpenAI buy Nvidia's hardware to run AI workloads inside hyperscale data centers, these aren't experimental systems. They're production-grade infrastructure designed to operate continuously at a global scale. So Nvidia sits at the center of the AI build-out because the entire generation of AI depends on the compute layer existing. This is where they claim that it's all hype doesn't really hold up, because by late 2025, Nvidia was reporting quarterly revenue above $57 billion, with over $51 billion coming from data center sales alone. Those are realized revenues and not projections. So the question isn't whether AI demand exists, because it clearly does. The question is whether the pace of investment and expansion implied by current valuations can continue. And the difference here does matter, because bubbles aren't about something being fake. They form when the price and expectations get ahead of what's realistically achievable in timelines that investors may be assuming. What has Wall Street worried, and where investors may start to get uncomfortable, isn't Nvidia's earnings. It's the structure forming around the ecosystem. Nvidia has made public its intent to invest up to $100 billion in OpenAI over time, tied to infrastructure deployment. Now, on its own, this isn't unusual. Strategic partnerships and co-investments are common when new platforms are being built. The concern here is how the incentives line up. Nvidia supplies the chips that power AI, but it's also providing capital to one of the largest buyers of those chips. In simple terms, Nvidia is helping fund OpenAI's expansion, and OpenAI is then using that capital to purchase more Nvidia hardware for its data centers. What has investors even more worried is while OpenAI clearly leads the industry in usage and deployment, the financials show how expensive this phase still is. In the first half of 2025, OpenAI reported roughly $4.3 billion in revenue, while losses for the year reported at $8.5 billion. Now, this doesn't mean the business isn't real, but it may mean that the model is still in aggressive expansion mode where scale is prioritized over profitability. Downstream from all of this, we have market structure. By the end of 2025, roughly 38 to 40% of the S&P 500 by weight was concentrated in fewer than 10 companies, many of which are directly tied to AI spending, AI infrastructure, or AI-driven growth expectations. When market leadership becomes that concentrated, you don't need a collapse in fundamentals to see volatility. This is concerning. You only need expectations to stop rising at the same pace, and at that point, valuation compression alone can do all the damage. So when people ask whether the AI bubble bursts in 2026, the framing itself is misleading. The technology is real, the demand is real, and the revenues are real. What's uncertain is whether the speed of capital deployment, the structure of financing, and the market's tolerance for delayed profitability remain aligned. If this trade breaks, it probably won't be because AI disappears. It will be because spending slows, build-outs take longer, margins get pressured, or the market starts demanding return on capital instead of rewarding expansion. That wouldn't be a collapse, it would be a reset. And 2026 may be less about an AI bubble popping and more about the market deciding how much it's willing to pay for growth once infrastructure phase matures. For those looking to take their journey more seriously into 2026, we have daily conversations about macro environments and all different types of markets. Pro members also have access to trading view indicators, technical analysts, and macro analysts. So make sure you get in the Discord. There's a free version available for everyone. I'll leave a link for that down below. Also follow us on X, and if you did like the video, please leave a like and subscribe.